Imagine tuning into market whispers this morning to uncover that JPMorgan, the banking giant, fined nearly $1 billion for silver manipulation just 5 years ago, has stealthily dumped its legendary 200 million ounce short position and pivoted to a jaw-dropping net long of 750 million ounces, equivalent to nearly a full year's global mine output. This isn't a minor trade adjustment. It's a calculated reversal from suppressor to accumulator, potentially igniting the next phase in silver's volatile saga amid tightening supplies. What if this flip isn't just profit-seeking, but a strategic fortress against an impending storm revealing cracks in the system that have kept silver caged for decades? To fully contextualize this shift in the silver market, we must survey the broader forces at play. Silver embodies a dual identity as both a financial sanctuary and an irreplaceable industrial staple, integral to solar energy, electric vehicles, and advanced electronics where its properties enable efficiency gains. In late 2025, demand has hit unprecedented levels, with the Silver Institute estimating industrial usage surpassing 700 million ounces amid the U.S. push for green infrastructure and tech supremacy. At the center stands JPMorgan, a dominant force in COMEX futures with a storied role in price dynamics, now executing this position reversal amid global supply strains and geopolitical tensions. This development resonates with average Americans, as silver's trajectory influences costs for consumer gadgets and sustainable projects, potentially exacerbating inflation pressures, while investors view it as a counterweight to currency debasement in a landscape of mounting fiscal uncertainties. The unsettling revelation surfaces upon closer examination. Despite silver's climb above $79 per ounce this month, the bank's flip from short to long exposes a market where paper trades have long overshadowed physical realities, with JPMorgan's new stance commanding over 40% of COMEX open interest in a way that could dictate flows. On the ground, physical premiums for bars and coins in U.S. outlets reached 20% to 30% over spot, with dealers imposing rations amid vault depletions, contrasting sharply with futures quotes that underplay the scarcity. Mainstream financial narratives might frame this as institutional repositioning, but they downplay the bank's history of regulatory scrutiny and the timing's implications, sidestepping how such dominance could amplify volatility and leaving many unaware of the underlying power imbalances. Let's dissect the evidence underscoring this flip through accessible metrics that highlight its magnitude. JPMorgan's transformation unfolded between June and October 2025, when the bank liquidated its entire 200 million ounce short, a position that once represented a quarter of annual global production, and swung to a net long of 750 million ounces, valued at over $40 billion at current levels. This isn't speculation. Reports confirm the bank added 21 million ounces in just 6 weeks, amassing the world's largest physical silver stockpile. Compare this to the Hunt brothers' 1980 attempt, which relied on paper and collapsed under intervention. JPMorgan holds tangible metal, reducing similar risks. COMEX data amplifies the shift. Inventories have dropped to multi-year lows below 450 million ounces after 47 million withdrawn in December's opening, echoing shortages in other commodities like nickel, where position concentrations led to 250% spikes in days. This data initiates a chain of causes and effects that's heightening tensions across the silver ecosystem. It commences with JPMorgan's short closure. By exiting amid rising deficits, the bank avoids escalating losses as industrial bids strengthen, but their long accumulation removes a massive selling overhang, allowing prices to respond more freely to fundamentals. One repercussion leads to another. Reduced suppression attracts investment flows into ETFs like SLV, boosting open interest, and tightening the basis between paper and physical, where premiums widen as fabricators compete for deliverable ounces. Geopolitical overlays compound this. China's export restrictions, effective January 1st, curb outflows amid trade frictions, forcing Western reliance on depleted vaults and elevating lease rates into backwardation, signaling acute immediacy that draws momentum traders and squeezes remaining shorts. The buildup intensifies. U.S. policies accelerating EV and solar adoption spike fabrication independently, creating a loop where JPMorgan's dominance could facilitate delivery demands that overwhelm the system. These interactions reflect enduring patterns in silver's market behavior, where institutional dominance and supply pressures have historically catalyzed dramatic turns. Recall the 1980 episode, when the Hunt brothers' accumulation clashed with bank shorts, propelling prices from $6 to $50 in months as delivery failures mounted, a 700% gain rooted in similar position concentrations. In 2011, amid quantitative easing and recovering demand, bank repositioning contributed to a tripling to nearly $50 as deficits overwhelmed suppression tactics. Today's setup echoes those, but with amplified scale. Not amateur cornering, but a regulated giant flipping sides, controlling physical stocks amid structural industrial lock-in that past cycles lacked. Logic dictates that when the largest player aligns with bulls during chronic undersupply, now at 820 million ounces cumulatively, the path mirrors those explosive resolutions, not gradual evolutions. As JPMorgan's long stance solidifies and vaults approach critical lows, the market nears a pivotal moment where paper illusions yield to physical constraints. If delivery claims surge in early 2026, potentially driven by the bank's position exercising rights, or if China's restrictions bite harder than anticipated, the squeeze could unfold swiftly, pushing prices through $90 as shorts capitulate in waves. Escalating trade measures or confirmed disruptions from key miners would compress this timeline, creating volatility that redefines hedging norms. What lies beyond carries profound ramifications for valuations, industries, and geopolitics. In constructive scenarios, elevated levels stimulate diversified mining in stable jurisdictions like the US, adding ounces over the decade, while fostering recycling efficiencies to ease pressures without halting tech progress. Governments might negotiate supply pacts, stabilizing chains for strategic needs. On the adverse side, prolonged tightness could inflate costs for US electronics by 20%, delaying infrastructure and sparking retaliatory policies that fragment trade. Investors face an asset intertwining monetary refuge with growth exposure, though dominance risks demand scrutiny. Yet, as JPMorgan transitions from manipulator to mega bull, one inescapable fact emerges. The bank's secret play unveils a market on the brink, urging vigilance, before the next act alters the playing field irrevocably. As JPMorgan's pivot gains traction in market consciousness, the silver landscape undergoes a profound reconfiguration that exposes long-standing vulnerabilities. The bank's net, long of 750 million ounces, not only eliminates a persistent source of downward pressure, but positions it as the primary accumulator of physical metal, with vaults reporting increased inflows tied to this stance. This dominance interacts with global supply dynamics. China's refined output, already constrained by new export licensing, effective January 1st, faces additional scrutiny amid trade tensions, potentially redirecting ounces domestically and tightening Western access. The synergy escalates. Reduced selling from JPMorgan allows industrial bids to lift futures unchecked, while physical tightness from restricted flows widens the basis, elevating premiums and lease rates that make short maintenance prohibitive. This intensification aligns with macroeconomic undercurrents that favor hard assets. Ongoing fiscal expansions and rate trajectories sustain currency dilution, directing institutional capital toward commodities as diversification tools. Yet silver's industrial backbone, consuming 60% of supply, amplifies exposure to growth themes in renewables and tech. JPMorgan's reversal, informed by past finds and forward assessment, acknowledges that suppression yields negative returns against embedded deficits, instead capitalizing on scarcity through accumulation. The compounding manifests regionally. U.S. fabricators ramp procurement for solar and EV components, depleting COMEX deliverable stocks and fostering backwardation signals that validate upward momentum. The parallel to silver's pivotal institutional shifts sharpens under these conditions. The 1980 buildup featured concentrated buying clashing with established shorts, collapsing defenses for historic extensions as physical demands overwhelmed paper. In 2011, similar bank adjustments amid liquidity injections and demand recovery produced rapid multiples before reversal. Contemporary elements surpassed those in foundation. Not speculative attempts, but a regulated entity's strategic alignment with structural consumption, controlling tangible holdings amid multi-year undersupply. When the dominant player transitions from bear to bull during geopolitical supply risks, outcomes follow precedents of pronounced recalibration. With JPMorgan's position entrenched and external catalysts like export curbs activating, the market approaches a decisive inflection where dominance tips the balance. If the bank pursues delivery to secure its long, or if industrial stockpiling surges in response to restrictions, registered ounces could vanish rapidly, igniting a covering cascade that gaps prices higher. Heightened regulatory scrutiny or trade escalations would hasten this, generating volatility that challenges traditional positioning. The horizon reshapes pricing, logistics, and strategic frameworks extensively. Constructively, sustained levels could incentivize mining diversification in North America, yielding additions over the decade while advancing recycling to mitigate tightness without impeding innovation. Diplomatic channels might secure alternative flows for critical applications. Strained paths involve cascading disruptions, elevating U.S. manufacturing costs, testing growth ambitions, and prompting policy responses. Investors navigate terrain embedding monetary defense with industrial leverage, moderated by concentration risks. As JPMorgan completes its transformation from manipulator to megabull, the silver domain affirms a lasting pivot. Institutional realignment is dismantling entrenched controls, compelling global acknowledgement of a market where physical imperatives now hold sway. As JPMorgan's strategic reversal embeds itself in the silver market structure, the dynamics evolve in ways that challenge conventional containment strategies. The bank's 750 million ounce long, now the largest concentrated holding globally, functions as both shield and catalyst, insulating against downside while actively bidding for metal that tightens liquidity for others. This concentration intersects with supply-side pressures. China's export licensing, now active, introduces friction into refined flows that have supported Western fabrication, potentially withholding tens of millions of ounces annually amid domestic priorities. The convergence accelerates, JPMorgan's accumulation elevates clearing prices for physical, widening spreads that manifest in dealer premiums and exchange backwardation, while curtailed Chinese shipments force alternative sourcing from already depleted channels. This escalation dovetails with broader economic signals favoring tangible assets. Fiscal trajectories and monetary accommodation perpetuate fiat dilution, steering institutional allocations toward commodities as portfolio stabilizers. Yet silver's industrial entrenchment, driving 60% of consumption, ties it uniquely to growth narratives in electrification and digitization. JPMorgan's shift, shaped by historical penalties and current calculus, recognizes that defensive shorting erodes viability against embedded shortages, opting instead for offensive positioning to harvest upside. The amplification emerges regionally. U.S. manufacturers accelerate procurement for AI hardware and solar modules, straining COMEX deliverable reserves and sustaining lease rate elevations that erode short profitability. The alignment with silver's documented institutional turning points intensifies as dominance solidifies. The 1980 confrontation involved aggressive buying, overwhelming bank defenses, yielding multiples as physical claims exposed paper vulnerabilities. The 2011 advance featured similar repositioning amid liquidity surges and demand revival, generating swift extensions before correction. Present-day parallels exceed those in resilience, not external challengers, but an insider giant aligning with fundamentals, commanding physical stocks amid geopolitical supply overlays. When the system's architect transitions allegiance during structural undersupply, trajectories conform to patterns of decisive upward resolution. With JPMorgan's long, fortified, and export regimes engaged, the market confronts a threshold where concentration catalyzes transformation. If the bank enforces delivery to materialize its position, or if industrial front-loading depletes remaining ounces, the covering wave could materialize abruptly, elevating prices sharply as liquidity evaporates. Regulatory interventions or trade intensifications would condense this process, producing swings that recalibrate risk across metals. The outlook redefines valuation, distribution, and governance paradigms deeply. Favorably, prolonged levels could mobilize capital toward diversified sources in North America, furnishing additions through the 2030s, while propelling reclamation innovations that alleviate constraints without hindering progress. Strategic dialogues might restore partial conduits for essential uses. Constraining avenues encompass entrenched disruptions, inflating U.S. production expenses, probing advancement sustainability, and eliciting responsive measures. Investors traverse terrain, fusing monetary safeguards with industrial premiums, balanced by oversight considerations. As JPMorgan consummates its evolution from manipulator to megabull, the silver realm validates an indelible metamorphosis. Institutional convergence is eradicating residual barriers, mandating universal recognition of a domain where tangible imperatives prevail unequivocally. As JPMorgan's role in the silver market evolves into one of outright bullish dominance, the consequences ripple through global trading patterns with increasing force. The bank's 750 million ounce long position, now a cornerstone of COMEX open interest, serves as a magnet for physical metal, drawing ounces that would otherwise circulate freely and reducing available liquidity for speculative shorts. This concentration dovetails with supply-side evolutions. China's refined silver, long a reliable export stream, faces new licensing hurdles that prioritize internal consumption, potentially constraining global flows by significant volumes at a time when industrial needs show no retreat. The interaction deepens. JPMorgan's buying power sustains bids on dips, elevating spot levels that widen physical premiums and reinforce backwardation, while restricted Chinese shipments compel Western refiners to compete more aggressively for alternative sources already under strain. This deepening ties into systemic trends that bolster commodity appeal. Persistent fiscal imbalances and monetary trajectories erode fiat confidence, prompting institutional reallocations toward tangible stores of value. Yet silver's hybrid profile, monetary plus industrial, positions it uniquely at the intersection of inflation hedges and growth plays. JPMorgan's transformation, guided by past regulatory lessons and present opportunities, illustrates that maintaining suppression incurs mounting costs against structural deficits, favoring accumulation to capture embedded scarcity. The amplification appears in operational realities. U.S. tech firms ramp silver-intensive components for AI servers and solar inverters, depleting regional stocks and sustaining elevated lease rates that deter short exposure. The congruence with silver's landmark institutional reversals becomes irrefutable as concentration endures. The 1980 confrontation saw aggressive accumulation dismantle bank-led containment, unleashing multiples as physical imperatives prevailed. The 2011 escalation involved comparable repositioning amid liquidity abundance and demand resurgence, yielding swift advances before equilibrium returned. Today's framework transcends those in durability, not outsider challenges, but an embedded powerhouse aligning with fundamentals, commanding physical reserves amid geopolitical supply overlays. When the system's steward embraces bullish conviction during entrenched undersupply, pathways conform to precedents of resolute upward momentum. With JPMorgan's stance consolidated and supply frictions entrenched, the market confronts an irreversible juncture where dominance reshapes equilibrium. If the bank leverages its position for substantial delivery, or if industrial procurement intensifies amid export constraints, deliverable ounces could diminish critically, precipitating a covering surge that redefines pricing overnight. Intensified oversight or trade developments would contract this window, manifesting volatility that alters risk perceptions across precious metals. The prospective terrain profoundly alters valuation paradigms, logistical networks, and strategic imperatives. In measured trajectories, sustained elevations could redirect capital toward diversified mining in North America, supplying meaningful additions through the 2030s while propelling reclamation advancements that temper shortages without compromising technological trajectories. Collaborative frameworks might restore calibrated flows for vital applications. Restrictive alternatives feature persistent disruptions, elevating U.S. production expenditures, appraising developmental viability, and inciting adaptive policies. Investors traverse a domain integrating monetary resilience with industrial premiums, tempered by oversight dynamics. As JPMorgan finalizes its metamorphosis from manipulator to megabull, the silver ecosystem substantiates a conclusive evolution. Institutional allegiance has dismantled residual restraints, necessitating global assimilation of a reality where physical fundamentals command unequivocal authority.